Hello and welcome. Today we shall be taking a look at multinational medical equipment manufacturer Smith&Nephew PLC. The company has a market capital of £12.59 billion and is currently ranked 36th in the UK FTSE 100 index. In the financial year to December 2018, Smith&Nephew had a turnover of £3.77 billion and an operating profit before tax of £601 million, which gave it a margin of 15.9%. It currently pays an annual dividend yield of 1.96%, which is paid semi-annually in October and May. This dividend is covered 2.1 times by the earnings per share. The group can trace its history back to 1856, when Thomas James Smith opened a small pharmacy in Hull in England. In 1896, Smith was joined by his nephew, Horatio Nelson Smith, and the business became known as T.J. Smith&Nephew. The company was incorporated and listed on the London Stock Exchange in 1937, and in 1999 the group was also listed on the New York Stock Exchange. In 2001, Smith&Nephew became a constituent member of the UK FTSE 100 index. The current CEO, Namal Noana, was appointed in May 2018. He succeeded Olivier Bohorn, who was served since April 2011. Noana was CEO from October 2014 until October 2017 for the medical diagnostics company Alera. Prior to that, he spent more than 15 years at Johnson & Johnson. In January 2018, Mr. Noana was appointed to the board of Hologic in Massachusetts and is still a director. Smith&Nephew are a UK multinational medical equipment manufacturing company. With headquarters in London, it employs more than 15,000 people worldwide. Its products are sold in over 120 countries to support healthcare professionals. They have manufacturing facilities in the US, China, Costa Rica, Switzerland, India, Germany, Russia, Curacao and the UK. Smith&Nephew's operations are organised into geographical selling regions and product franchises within the medical technology industry. The United States is the group's largest market, with established markets comprising commercial operations in Europe, Australia, Japan, Canada and New Zealand. Emerging markets include commercial businesses in China, Asia, India, Russia, Middle East, Africa and Latin America. For the previous 5 years, Smith&Nephew has had a consistent revenue of between £3.55 and £3.77 billion and an operating profit margin ranging from 12.1 to 22.7%, which gave it an average of 16.9%. The forecast for next year is a revenue of around £3.8 billion and a margin of 19%. With generated earnings for the previous 5 years of between 35p and 68p per share, the dividend has always been covered by at least 1.46 times the earnings per share. The share price standard deviation for 2018 was 61, compared to 310 for the FTSE 100. The current share price is 72% above the 52-week intraday low. The RNS on the 4th of April announced that Namal Noana will join the company as Chief Executive Officer and be appointed to the board as Executive Director on the 7th of May 2018. Most recently, Namal was Chief Executive Officer at medical diagnostics company Alera, which he joined as Chief Operating Officer in December 2012. He led the successful turnaround of this global business and oversaw its $5.3 billion acquisition of Abbott in 2017. Prior to Alera, Namal spent more than 15 years at Johnson & Johnson. The Q1 trading update on the 3rd of May, the revenue of established markets, which was responsible for almost 85% of the group turnover, was down 2%. Emerging markets continued to deliver strong growth, with revenues up 9%. Due to the impact of the weaker Q1 trading, the full-year revenue growth was now expected to be in the region of 2 to 3%, and the trading profit margin at or above that achieved in 2017. On the 9th of May, CEO Namal Noana purchased £2.95 million worth of shares at 1,316p each. On the 26th of July 2018, it reported revenue was up 2% for the half year. On the 3rd of November, the Q3 trading update revenue was up 3% and its full year guidance was, as previously predicted, at the lower half of the 2 to 3% range. On the 18th of December, Smith&Nephew announced it had agreed to acquire Ceterex Orthopedics. Smith&Nephew would pay an initial cash consideration of $50 million and up to further $55 million over the next 5 years, contingent on financial performance. The acquisition was completed on the 22nd of January 2019. The acquisition was financed from existing cash and debt facilities. On the 7th of February 2019, full-year results were announced. Revenue was up 2%, but basic earnings per share was down from 87.8 cents in 2017 to 76 cents. There was strong growth in reconstruction products and emerging markets with double-digit growth in China. Although Smith&Nephew invests 5% of revenue each year to develop new products, they are not the world leader. They are second in sports medicine and advanced wound management and fourth in hip and knee reconstruction implants and trauma and extremities. Smith&Nephew are making good progress in a number of lucrative emerging markets, with revenue increasing 9.7% from $601 million in 2017 to $660 million in 2018. The share price has fallen recently, but the price-earnings ratio of 24.3 is still considered high compared to the FTSE 100 average of 11.6. Smith&Nephew pays a dividend yield of 1.96% compared to the FTSE 100 average of 4.4%, and it is covered 2.1 times by earnings. For these reasons, I have given Smith&Nephew an overall rating of 4 out of 5. Thank you for watching. Please leave comments below. And also like and subscribe for further analysis of UK company businesses.